When investing to build long-term wealth, it's crucial to have a solid core in your portfolio. This not only reduces some of the volatility, but also delivers consistent results over the years. Prominent investors like Warren Buffett highlight the importance of long-term wealth building. Their key strategies include patience and diversification. A straightforward way to diversify your portfolio from the outset is by investing in ETFs, exchange-traded funds. Think of ETFs as baskets of stocks. These baskets can range from large ones containing hundreds or even thousands of stocks to smaller ones with around 30 different stocks. There are various types of ETFs, such as those focused on dividends, growth, and specific sectors. In today's video, we'll discuss 5 top ETFs that, in my opinion, can serve as the foundation of your portfolio. Before we begin, please click the like button below, subscribe to the channel, and hit the notification bell to stay updated with our latest content. Now, let's dive into today's video, where we'll explore 5 top ETFs to help anchor your portfolio, starting with the Vanguard S&P 500 ETF, ticker symbol VOO. I believe every portfolio should start here, as it includes 500 of the best companies in the US. VOO is my top holding and will likely remain so for decades. By investing in VOO, you own shares in 500 of the best companies in the US and globally. VOO is one of the most widely held ETFs, with $1 trillion in assets under management and a very low expense ratio of 0.3%. Over the past decade, VOO has increased by 76% and offers a dividend yield of 14%. It provides excellent diversification. Here's the sector breakdown. Technology accounts for 31% of the fund, healthcare 13%, financials 13%, consumer discretionary 11%, and communication services 9%. The top 10 holdings include Microsoft, Apple, Nvidia, Amazon, Meta Platforms, Alphabet, Berkshire Hathaway, Alphabet Class C shares, Eli Lilly, and Broadcom. These top 10 stocks make up 32% of the ETF. You might wonder why VOO has 508 total positions if it tracks the S&P 500. This is because some companies, like Alphabet and Berkshire Hathaway, have multiple classes of stock, all of which are included in the ETF. You're gaining broad exposure to some of the top US companies, particularly in the booming technology sector over the past year. Now, let's discuss the second buy and hold ETFs, QQQM, the Invesco NASDAQ 100 ETF. This is the sister fund to the popular QQQ, but for our focus on buy and hold strategies, we prefer QQQM. Although similar to QQQ, QQQM has a lower expense ratio, which benefits long-term investors. QQQM manages $23 billion in assets, making it much smaller than QQQ, which has $255 billion. The expense ratio for QQQM is 0.15%, compared to QQQ's 0.2%. Over the past 12 months, QQQM has risen by 41% and has a dividend yield of 0.66%. This ETF emphasizes growth with significant exposure to the technology sector, overlapping considerably with VOO and QQQM. Consider this before investing. In terms of sector allocation, QQQM has an even greater emphasis on technology than the S&P 500, with 50% in technology, followed by 16% in communication services, 13% in consumer discretionary, 6% in healthcare, and 6% in consumer staples. The top holdings include well-known companies like Microsoft, Apple, Nvidia, Amazon, Meta Platforms, Broadcom, both classes of Alphabet shares, Tesla, and Costco. These top 10 stocks make up 47% of the ETF, which holds a total of 104 positions, indicating a higher concentration in technology. Next, let's consider the third buy and hold ETF, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. You didn't think we'd discuss top ETFs without mentioning one of my favorites, did you? SCHD is my preferred dividend-focused ETF because it covers many important aspects. There are various dividend-focused ETFs, some prioritizing dividend growth and others high yield. SCHD strikes a balance with higher yields than some high-yield ETFs and faster growth than some dividend growth-focused ETFs. SCHD manages $55 billion in assets and has a very low expense ratio of just 0.6%. Over the past decade, SCHD has increased by 110%, with a dividend yield of 3.4% and a 5-year dividend growth rate of 12%. Why do I favor SCHD so much? Besides its strong dividend component, it complements VOO and QQQM, which are heavily weighted in technology. SCHD has much less technology exposure, further diversifying the portfolio. When the market rallies broadly, SCHD tends to perform well. Here's a look at the sector breakdown for SCHD. The top sectors in SCHD include financials at 17%, healthcare at 15%, industrials at 14%, consumer staples at 14%, and energy at 14%. This ETF is broadly diversified without heavy exposure to any single sector, with technology comprising only 86% of the fund. The top stocks in SCHD are Chevron, Lockheed Martin, Verizon Communications, Texas Instruments, UPS, PepsiCo, Cisco Systems, Bristol-Myers Squibb, BlackRock, and Pfizer. These top 10 holdings make up 39% of the ETF, which has a total of 104 positions. SCHD ticks many boxes for me. It diversifies my portfolio, complements S&P 500 and technology-heavy ETFs, and offers an excellent dividend yield with strong dividend growth. Next, let's look at the fourth buy and hold ETF, the iShares Core High Dividend ETF, ticker symbol HDV. This is another dividend-focused ETF, but it differs significantly from SCHD and the other ETFs we've discussed. If you seek stability and high quality, but still want some income, HDV is a great choice. It prioritizes quality over growth, often aligning with higher dividend payers. HDV manages $10 billion in assets and has a low expense ratio of 0.8%. Over the past decade, the fund has increased by nearly 50% and offers a dividend yield of 3.4%. The top 10 stocks in this ETF are well-known, mature, and stable companies that provide higher dividends rather than high growth. Examining the top sectors in HDV, energy leads at 27%, followed by consumer staples at 18%, healthcare at 17%, technology at 9%, and utilities at 8%. These defensive sectors, especially the large exposure to energy, have contributed to the ETF's strong recent performance. The top holdings in HDV include Exxon, Chevron, Verizon Communications, Johnson & Johnson, AbbVie, Philip Morris, PepsiCo, Coca-Cola, and Altria Group. These top 10 stocks account for 51% of the ETF, which has a total of 81 positions. The focus on stable companies in various sectors complements the other ETFs we've discussed. Finally, let's discuss the fifth buy and hold ETF, the Vanguard Total Stock Market ETF, ticker symbol VTI. If you seek diversification and a more hands-off approach, VTI is an excellent choice. Why is VTI so diversified? Because with VTI, you own a fraction of every public company in the US. This ETF is market cap weighted, so it has significant overlap with VOO at the top, featuring the largest US companies. However, the exposure is much broader as VTI includes thousands of stocks, not just 500. VTI manages $0.6 trillion in assets, making it a very large and popular ETF. The expense ratio is extremely low at 0.3%. Over the past decade, VTI has gained 163% and offers a dividend yield of 1.4%. It shares many similarities with the S&P 500 ETF, but with much lower weightings. Let's first examine the sector breakdown. Technology is the leading sector at 30%, followed by financials at 13%, healthcare at 12.5%, consumer discretionary at 11%, and industrials at 9.5%. Here are the top 10 positions in VTI: Microsoft, Apple, Nvidia, Amazon, Meta, Google, Berkshire Hathaway, Alphabet Class C shares, Eli Lilly, and Broadcom. These top 10 stocks make up only 28% of the ETF, which holds a total of 733 different companies. This ETF offers ultimate diversification, providing ownership in every US stock. While there are ETFs like VT that invest in every public company worldwide, I prefer focusing on the US market as a whole. That concludes our video for today, covering 5 top ETFs to buy and hold long-term to help diversify and build generational wealth. In the comments section below, let me know your top 5 ETFs for buy and hold investing, not for trading in and out, but ones you'd buy today and hold for decades. If you haven't done so yet, make sure to smash that like button, subscribe to the channel, and we'll see you in the next one.